So closing the books, basically, like I said, we have to end our accounting period and keep records separate year to year. Okay. So we have a start of the period, we have an end of the period. That's how it's done in reality. This particular textbook breaks it down so you can actually close your accounting period at the end of the month because it's just easier to calculate for a month than it is a year. So just keep in mind that the book is going to give you examples to close your record every month, whereas in reality, we would probably close it for sure. We have to close it every year. So, what do we close? Well, we have to close what's called temporary accounts. Temporary accounts means that they are subject to the periodicity assumption. They're part of that measurement of the accounting period. So, what do we measure in an accounting period? Well, we measure the income statement, right? So, income statement has all your revenue and expense accounts on it. If you look at an income statement as part of the title, it'll say for the period ending, right? For the month ending, for the quarter, for the year ending, boom. So it measures a period of time. So because it measures a period of time, it's a temporary account because at the end of that period, we have to close it. To close it. Closing an account, as you'll see, simply means the balance needs to be zero. And I'll teach you how to do that real quick. So your revenue and expense accounts are on the income statement. The income statement is part of periodicity because it measures a period of time. So it's going to be closed. The other statement that measures a period of time is the retained earnings statement. The retained earnings statement, as you know, takes the net income, which is the revenue and expense, you know, product, right? And subtracts out the dividends from it. So the dividends account then is subject to that accounting period, and so it needs to be closed at the end of the year. Not that any of this money is being missing, because as we close these records, we are transferring all of that to one of the permanent accounts. A permanent account is an account that's not subject to the periodicity assumption because it never closes. So the balance sheet doesn't measure a period of time, it measures a day. So all asset, liability, and stockholders' equity accounts are permanent accounts because they don't go through that process of needing to close at the end of a period of time. Okay. Now, like I said, your revenue and expense accounts give you your net income minus your dividends all get transferred into the retained earnings account, which is a permanent account. It's a stockholders' equity account. So it's not like we somehow erase all this data. We don't. We simply process the data, and as you know, we transfer it into retained earnings. That happens on the financial statements, right? We do the income statement first, then the net income gets put on the retained earnings statement. We take away the dividends, and then what do we do with that number? We transfer it to the balance sheet. So in essence, we're transferring it into a permanent account to get these accounts ready to close. So how do we close an account? So to close an account, we basically want to make sure that each of these accounts have a zero balance. So closing an account simply means the account has a zero balance. All right. So in order to do that, of course, you have to prepare entries. And so the closing process, very much like the adjusting process, starts in the journal. It's a 4-step process, and it's not that bad. You just simply have to follow the steps in order to do it. The first step is we close the revenue account. So the revenue account has a credit balance, right? So in order to close it, it has to have a zero balance. So how do you get a zero balance in any account? Both sides need to equal. The credit side and the debit side have to equal. So if you have $100 on the credit side and $100 on the debit side, you do not have a balance. It's a zero balance. And that's basically how we close an account. Both sides of the account need to equal. So revenue accounts have credit balances. So to close the revenue account, we will debit it. So the equal debit and credit side is equal. And then we transfer the money into a temporary account that you're going to learn about here called income summary. Income summary is simply a temporary account that we use to help close our books every year. The second thing we do is we close all our expense accounts. Now, expense accounts have balances on their debit side, as you know. So to close an expense account, both sides have to be equal. So we're going to be crediting each individual expense account and moving the total up to income summary. Okay, so just after the first two steps, we already have all of our revenue accounts closed, which means their balances are zero. And we have all of our expense accounts closed, which means their balances are zero. But now we have this sitting in income summary. Your income summary account is going to look like your income statement. On one side of the account, you're going to have all your revenue. On the other side of the account, you're going to have all your expenses. Why? Because you just closed them and moved all those totals here. So your income summary account is going to look like your income statement. Of course, your income statement will have the difference in revenue and expenses is your profit. And what do we do with that? Well, we simply, our third step is to close the income summary account by moving that profit into retained earnings. So that's the third step. We don't need the income summary account anymore. It served its purpose in allowing us to do this. And now we simply take the difference in income summary, which is the profit of the company, and move it directly into retained earnings. And the very last step we do is simply to close dividends directly into retained earnings. Dividends has a debit balance. So to close the dividends account, both sides have to equal. So we're going to have to credit the dividends account to get it to zero. And we move that into the retained earnings account. So that's the 4 steps. That's how they work. That's what you're going to be practicing. This is what it looks like in the journal. Again, if you hear the word entry, you know the entry point in accounting is the journal. Everything starts with the journal. Okay. So again, your very first thing that you do is close your revenue account. That's always the first thing. So to close the revenue account, you debit the revenue account so both sides are equal. That now has a zero balance. You move that into income summary. Okay. The second thing we do is close our expense accounts. Well, expense accounts all have debit balances, so each expense account needs to be credited an equal amount. So each balance is zero. And the total amount of expenses will be moved to the debit side of income summary. So income summary now has all of the revenue and all of the expenses sitting in it. The revenue is on the credit side of income summary. All the expenses are on the debit side of income summary. But now look what we've done. The first 2 steps are over. We've already closed our revenue and expense accounts. Amen. Now we can close our income summary account. We no longer need it now that we've closed revenue and expenses. Now we can move that into retained earnings. So we close the income summary account, which is simply the net profit. Remember, your income summary account is going to look like your income statement. You have revenues of 10,600. You have expenses of 7,740. This looks exactly like the income statement for Sierra Corporation. The profit is 2,860. Well, the profit will belong in retained earnings. So this credit to retained earnings is the same as adding the net income to retained earnings, which is what we do on the retained earnings statement, right? We add net income to retained earnings. That's the same as crediting net income. So right here, this 3 process closes up all of our income statement accounts and moves that money safely into retained earnings. The 4th step is to close dividends. Dividends closes directly into retained earnings. So retained earnings is going to get the debit that's sitting in dividends, and dividends will close on the credit side. Because again, to close an account, both the debit and credit side need to be equal. So there's zero balance in it. Right. So that's how it would look in the journal. This is a graphic of how it would look posting into the ledger. First step right here, right? Service revenue has a credit balance of $10,600 sitting in it. To close it, we debit it. See, if you have 10,600 in debits and 10,600 in credits, you don't have a balance. It's a zero balance. That's all closing is, making sure both sides are equal. Service revenue has a credit balance, so the zero would simply stay on the credit side because that's where normally we would put it. I can't hear you, Francis. You got a bad connection there. This $10,600 is all of the revenue sitting in the income summary account. The second thing we do is close each individual expense account. Again, expense accounts have their balances sitting on the debit side. So to close it, the equal amount has to be put on the credit side. And thus your balances will be zero in all your expense accounts. And the $7,740 are all your expenses sitting now in income summary. So your income summary looks like your income statement. All the revenue is on one side, all the expenses are on the other side. The difference will be the profit. The profit belongs in retained earnings. So we close the income summary account. Again, to close the account, both sides need to be equal. We move that over to the retained earnings. And the last step we do is close dividends and move the dividends into retained earnings. Look at the retained earnings account. It looks like the retained earnings statement, right? Started with a zero balance. We added the net income of 2,860. We subtracted the dividends of 500, and we got a new ending balance in retained earnings of 2,360. Sorry. This is what goes on the balance sheet. So this already is in a permanent account. So this allows us to close all of our temporary accounts. At the end of that process, literally we run another trial balance called a post-closing trial balance, which simply will show that all of our temporary accounts, which is the revenue, expense, and dividends account, will have a zero balance now. And we're closed. And we're good. Okay. Look at what we've done. Look at what you've been through recently. So learning the steps 1, 2, 3, and 4, all of these steps were part of chapter 3. Steps 5 all the way to 9 are chapter 4. Together, that's the entire accounting cycle. That's the bookkeeping cycle or the accounting cycle. That happens all the time. Okay. But we do have to keep those records separate, usually month to month, but definitely year to year. That's the longest we can measure this. The cycle has to come to an end and start anew. So it's quite a lot what you've just looked at, and that's just a graphic of what those steps are. Let's take a look at the do it exercise here that you'll be doing for homework as well. So you have a company called Hancock, and they have some selected accounts on its adjusted trial balance here. And they want you to prepare the entries to close revenue. So the very first thing we want to do is close our revenue account. So we have to pick out our revenue account on this list. Service revenue is it. It has a $98,000 balance that if it's a revenue account, this is sitting on the credit side. So in order to close the account, we're going to have to debit the revenue account by that amount to close it. And we move that into income summary. So the very first step is we debit the service revenue account and we credit income summary by the same amount. So now our revenue account is closed. The second thing we do is we have to close our expense accounts. Now there are a number of expense accounts, so we have to identify them. The rent expense, salaries or wages expense, and supplies expense. Those are the 3 expense accounts that are listed here. So each one of those expense accounts needs to have a zero balance, and we move the sum into income summary. So what you see here is we have a total of $80,000 of expenses that are going to sit on income summary. Each individual expense gets its credit to close out the account. Right. Remember, expense accounts have debit balances. To close them, we need to credit each account to bring it to zero. Again, closing is simply bringing the balance to zero. But look at your income summary account now. It's going to look, you can tell what the income statement would look like simply by looking at this. This 98,000 is all the revenue. This 80,000 is all the expenses. Can you tell me whether this company had a profit or a loss? Yes, it had a profit, $18,000 profit. So that is the third step. The third thing we do is we close income summary. Well, we have a profit of 18,000 sitting in income summary. Where does it belong? Belongs in retained earnings. And so we debit the income summary account by 18,000 and we move that 18,000 to retained earnings. And the very last thing we do is close the dividends account. The dividends account has $15,000 in it. We close it by crediting the dividends account and moving that debit to retained earnings. Now notice something here. We only dealt with the closing entries, the 4 steps that we talked about, right? There are some accounts that are here that are not part of the closing process. Accounts payable is a liability account. It's a permanent account. It doesn't go through a closing process, so you can ignore it. Accounts receivable is a permanent account, an asset. It's a permanent account. It doesn't go through the process, so you can ignore that number as well. Right? So the numbers you need, of course, your revenues, your expenses, your dividends, all those are very, very important. Okay. And that's how you would do the closing entries. And we're back to the main room now. Questions? How did that go?